What if a single decision made in a boardroom in Washington, D.C. could put more money in your pocket, boost your retirement savings, and even lower your mortgage payment in 2025? You've seen the headlines, Fed pivot imminent. But behind the financial jargon lies a real-world impact on your life. The question is, will you be prepared or will you be left watching from the sidelines? Welcome back to Asset Bloom. Today we're decoding exactly what the Federal Reserve's rate cuts mean for your retirement, your mortgage, and your investments. We're moving beyond the headlines to give you a clear, step-by-step action plan. Stay tuned, because by the end of this video, you'll know exactly how to position your finances to not just survive, but thrive. Why? Behind the cuts first, a quick 60-second recap on why this is happening. The Federal Reserve's primary tool for managing the economy is the interest rate. When inflation was soaring, they aggressively raised rates to cool down spending and bring prices under control. Think of it as tapping the brakes on the economy. And it worked. Inflation is now trending down. So the Fed's next job is to avoid stepping on the brakes too hard and causing a recession. To do that, they plan to cut rates in 2025, gently pressing the accelerator to encourage borrowing and spending again. It's a delicate dance. But for us, the most important thing isn't the dance itself, it's how we can move with the music. Let's break it down into 3 key areas. The impact on your investments. Let's start with your investments, because this is where the most immediate opportunity lies. Lower interest rates are generally like rocket fuel for the stock market, but you need to know where to aim. First, growth stocks. When borrowing money is cheap, companies can invest more in growth, hiring, research, and expansion. This is especially true for tech and other growth sectors that rely on financing for their future potential. In a lower rate environment, the value of their future earnings looks more attractive. So, if you're invested in broad market index funds like the S&P 500 or NASDAQ 100 ETFs, like VOO or QQQ, you're well positioned to benefit from this tailwind. Practical example. Let's say you have $20,000 in a growth-oriented ETF. Historical data suggests that the initial phase of a rate-cutting cycle can provide a significant boost. A conservative estimate of a 10 to 15% gain in this environment would mean an extra $2,000 to $3,000 on your investment. That's not just a number on a screen. That's a family vacation, or a chunk of your retirement savings created by understanding the macroeconomic shift. Second, the bond market. This is critical. Bond prices move inversely to interest rates. So if you already own bonds or bond funds, like BND or AGG, your existing holdings, which were issued at higher, more attractive rates, will suddenly increase in value. Why? Because new bonds being issued will have lower yields, making yours more desirable. Actionable advice. If you've been holding bonds through the rate hikes, you may finally see some capital appreciation. However, if you're looking to buy new bonds for income in 2025, be prepared for lower yields. This might lead some investors to consider dividend-paying stocks for income, but that comes with higher risk. The impact on your mortgage and housing. This is perhaps the most tangible impact for many people. The housing market has been in a deep freeze, largely due to high mortgage rates. Rate cuts are the spring thaw. If you have an adjustable rate mortgage, ARM, this is your most direct benefit. Your interest rate is tied to a benchmark that follows the Fed. When the Fed cuts rates, your monthly payment will likely go down. This is straight-up relief for your household budget. Practical example. A family with a $500,000 ARM could see their monthly payment drop by $200 or more for every half-point cut. That's $20,400 a year back in your pocket. Money that can go to savings, investments, or paying down other debt. If you're a prospective homebuyer, get ready for a mixed bag. The good news is obvious. Lower fixed mortgage rates mean your borrowing power increases. A payment that was unaffordable at 7% might be within reach at 5.5%. But here is the reality check. You won to be the only one with this idea. Lower rates will unleash pent-up demand. More buyers competing for the same number of houses will likely keep prices high, or even push them higher. So, while your monthly cost may go down, the purchase price might not. Actionable advice. 1. Get pre-approved now. Beat the rush. When rates drop, competition will be fierce. 2. Be patient but decisive. The window for deal-making might narrow. Focus on locking in a lower long-term fixed rate to protect yourself for the future. A quick note for our UK and Canadian viewers. While the Fed directly affects the US, the Bank of England and Bank of Canada are often influenced by the same global economic trends. If the Fed is cutting, it gives other central banks more flexibility to do the same without hurting their currencies too much. So the same principles apply to your variable rate mortgages and housing markets. Stay informed about your local central bank's announcements. The impact on your retirement strategy. This is the big picture. How you should respond to rate cuts depends entirely on your stage in the retirement journey. If you are in the accumulation phase, 10+ years from retirement, and this environment is your friend. A growing economy fueled by lower rates is typically good for stock growth. Your strategy is simple. Stay the course. Continue your consistent contributions to your 401k, IRA, RRSP, or other retirement accounts. The potential market growth we discussed can significantly compound over time. Don't try to time the market. Just keep investing. If you are nearing or in retirement, your focus shifts from growth to income and capital preservation. Here's your 2-step checkup. 1. The good news. If you hold bonds in your portfolio, their value may be rising, which is great for your overall net worth. 2. The challenge. The interest income from new bonds, CDs, or high-yield savings accounts will start to shrink. That 5% you were getting on your cash, it might drift down to 3% or 4%. Actionable steps. This is a time to potentially diversify your income sources. You might cautiously explore high-quality dividend stocks, but always prioritize safety. Most importantly, this is a perfect moment to review your withdrawal rate with a financial advisor to ensure your nest egg lasts, especially if safe income is declining. So let's bring it all together. The Fed cutting rates in 2025 is a shift from defense to offense. For your investments, it's a potential green light for growth. For your mortgage, it means opportunity mixed with competition. For your retirement, it means a crucial checkup based on your life stage. The key is to be proactive. Use this information now to review your portfolio, understand your mortgage terms, and refine your retirement plan. Now, I want to hear from you. What's your biggest question about the upcoming rate cuts? Are you most excited about the investment potential or worried about your retirement income? Let me know in the comments below. I read every single one. If you found this guide helpful and want to make sure your assets bloom in 2025, then please hit that like button and subscribe to Asset Bloom. Tap the bell so you don't miss our next video, where we'll be breaking down how to build a recession-resistant portfolio. Thank you so much for watching. Until next time, keep investing in your knowledge.